Hi, Dan Casey here. Thanks for tuning in. We all know Tony Robbins, right? Personal life coach for presidents, prime ministers, famous people all around the world. Well, he's written a first book in 20 years, and it's about money management and personal finance. And it seems like it's going to be a great book. It just came out. There was an hour-and-a-half interview with him. So I'm going to splice out some of the best parts from that interview and comment on it here. Because a lot of what Tony Robbins says are things that I've been saying in my seminars and in my latest book. So I want to comment on those. All right, so let's run that first, the first section.
So a fiduciary is a big word, or registered investment advisor, words most people will be overwhelmed by, is somebody whose job it is they only get paid, not commissions, only get paid to serve your interest. And they can pick from anything. So I went to one of the largest registered investment advisors in the world, a group called Hightower. They have 30 billion in assets, but they only serve, the wealthiest people in the world. And I said to them, I met with the founder, his name's Elliot, brilliant man. And I said, Elliot, you care so much about full transparency, people not being cheated, fees, ripping out and stripping out all the fees, showing what's real, but you're helping the wealthiest people in the world. How about the average person? The average person, 50% of the United States has less than $25,000 of assets. He said, Tony, I'd love to help them, but you can't make money doing that. I said, you don't need to make money. You're making plenty of money. I said, how about, and I introduced him to a person who's been working and managing my assets for about 7 years now, a man named AJ Gupta of Stronghold. So why don't you guys come together and use technology and create a way for people to go online, be able to put in whatever they have in their accounts and have it automatically show them what they're really paying. Most people have no clue what they're really paying versus what they could get the same stock or bond for. A lot of times you'd be paying 10 or 20 times more to buy the same stocks or bonds in your mutual fund that you could have in something called an index that costs 30 times less, 20 times less, 10 times less, exact same product. But you'll know that the minute you click the button. I want them to know. I said, why don't you design it so they can immediately see how much exposure they have? What's the volatility? How about you make it so you can compare it to other choices? What's their real return for their investments? Most people have no clue. Show it to them in seconds and do it for free. He said, well, how do I make money? I said, some of the wealthier ones will become clients of yours. The ones that aren't, you show them how to do it, and hopefully they'll grow and become clients. So based on the goodwill, those two groups, Stronghold and this group Hightower, have come together and formed this. And it's kind of like a, test your broker, take your broker for a drive. So you can find out these things I'm talking about by pushing a button.
You don't have to spend 3 weeks
no,
like
you don't have to go through all that stuff
an economist reading the...
Yes, and I'm proud of the role that I played in putting these guys together, to say the least.
Okay, so we hit on being a registered investment advisor, which is what I am and what my company, Bridge River Advisors, is, a registered investment advisory firm. So we accept no commissions for any of the investment products that we recommend for our clients. That's what he's talking about here. And he hit a little bit on indexing and index funds, which is something I've always recommended. I usually recommend ETFs, which is just a basket of stocks. There's no money manager in there messing with it like in a mutual fund. All right, second clip.
Here's one for you. Another lie. 96% of mutual funds, 96% don't match the market, meaning they're not the same as if you just bought what's called an index. An index is just a piece of all the biggest companies, for example, the S&P, the Standard & Poor's. You don't have to spend any money to buy that index, like 0.20%, not 3%. And you get the same companies, Apple, all these great companies. 96% of mutual funds over a 10-year period don't match that. So what does that mean? It means only 4% succeed in a 10-year period, and the 4% is always changing. So let me help this for anybody listening. So they go, oh, it's math. No, what do you mean?
What is this math business in which you speak?
Let me show you. Watch this. So I'll give you an example so these numbers come to life for you. If 96% of the chances you're going to pick the wrong mutual fund, you only got a 4% chance of succeeding, right? That's major league gambling. So let's say you play blackjack, and anybody's played blackjack, it's 21, right? And you get 2 face cards drop on you. 20 in front of you, 21. And some inner idiot in you says, hit me. You have an 8% chance of getting 21 with 2 face cards. You have a 4% chance of picking the right mutual fund.
I think I'd rather take the 21.
So, but what I show you is you can get the market. You can become an investor in American business and not have any of those fees, almost nothing, 20 basis points, for example, with a company like Vanguard. And now you get to grow with all of American business, which has done well in recessions, depressions. They've always found a way to rebound. And those are the people who have done well. Equities have done extremely well. Now, that's not the only investment in the world.
Again, no mutual funds, just the index funds or the ETFs, basket of stocks. He just really hits on something that really the entire industry has been talking about for years, how you get a money manager in these mutual funds. They're buying and selling these stocks inside a mutual fund, and by the time you pay all the fees and the turnover costs, these guys can't even outperform the benchmark that they're trying to outperform. You get into a broad market index mutual fund, you expect it to outperform the S&P 500, right? Because you got a smart guy in there buying and selling stocks, right? Wrong. Most of them can't, which is why I always recommend the ETFs or the index fund, very low in fees, and they usually outperform mutual funds a lot of times. All right, let's watch the third clip.
Great.
Completely out.
One of the biggest things that I think really deserves careful attention are these fees.
Yes.
So because of the 3%, that means you have to make 3% just to break even. And what now, when the folks you were talking about and that you have interviewed, these 50 masters, when they talk about, surely they talk about kind of an average return.
Yes.
Can you share that number?
Well, it depends on who it is. They all have radically different returns. But I'll tell you, if you can be in a position where you make 8 to 10%, but you do it efficiently. So I'll give you an example. Let's say today someone makes a 6% return. And that's not uncommon. We had an explosive year in the stock market, just recently. But overall, 6 to 8% is a range that most people count on. The market over the last 20 years has averaged about 9%. The average investor who's in mutual funds has averaged 2.5%. That's according to Dalbar, one of the biggest research companies that's out there.
So you're already a basis point or so behind, or 10 basis points behind.
More than basis points. I'm talking about percentages. Let me give you an example. Let's say you made 6% and you're paying 3.1% in fees. You have 2.9% left. If you're investing in a mutual fund, they tell you buy and hold. They don't buy and hold. They constantly trade. Because they constantly trade and don't hold those assets long, you don't get an investment tax rate. You're charged ordinary income tax rate. So somebody like you're going to pay 50% on that amount they did. So check it out. You made a return, right? They're going to charge you a fee first, 6%. They're going to charge you, let's call it 3 for simple math. You got 3 left, and now you're going to pay 50% on that. So you got a big total of 1.5% while you took all the rest of the stock market.
I could have just gone to the bank and bought a CD or something.
Well, that's what I'm trying to tell you. Dalbar showed at 2.5%, you could have had treasuries, no risk, and done better than most mutual fund investors. The market does one thing, what you do is another. If you don't understand fees, if you don't understand taxes, and what's so cool is it's not that complex. There's a way to put kind of an umbrella around you tax-wise, legally, the IRS sanctions it. It's been used by wealthy people forever. I walk you through how you can do it for yourself. It changes the game. It allows you to get to your goals 30 to 50% faster. And it doesn't matter when you started.
It almost sounds like a major part of this, not to oversimplify it, but from my translation is learn all of the dumb stuff that everyone's doing and stop doing the dumb stuff.
Yes.
That most of these extremely successful, brilliant people have just cut out a lot of the really dumb stuff.
Okay, so we hit again on the constant trading inside mutual funds and how that leads to extra fees. But what he hit on here, which is a great point also, is a lot of times mutual fund managers will buy a stock and sell it within the same year. What that does is it produces short-term gains. If you're in a higher tax bracket, that spells trouble for you because you have to pay taxes on those trades at whatever tax bracket you're in, not the lower capital gains taxes. And mutual funds do that a lot. You'll get short-term gains in there and have to pay high taxes on those. So again, why mutual funds usually don't make sense. Index funds or ETFs, where you get a basket of stocks, there's no buying and selling, so no capital gains are created or minimal capital gains.
The final purpose of all investing is income, and most of us don't know that anymore because all of the marketing machines, large banks, if you are taking income, it's no longer in their account.
So it's bad.
So it takes it away from them. So one of the things that I looked at was I started looking around, and most people know the power of life insurance, right? Don't like it, but I want to make sure if something happens to me, my family's taken care of. But what if you live? And here's what's crazy. The number one fear amongst baby boomers is not death. Death is a far number 2, way down the list, number 2 percentage-wise. Number 1 is running out of money before they die, having a life where they don't have income. And it's going to happen, according to all the statistics, to about 75% of the population, right? It's mind-boggling. So what do I do without any income? That's why you see people now in their 70s as greeters at Walmart. It's just they got to figure out what to do because they never figured this stuff out in the beginning. So there is income insurance. Income insurance is old. It's a 2,000-year-old approach to making sure you have money. Julius Caesar was the first one who created it. And here's what it was. They created a pool of money where the soldier's going to go out. And everybody put their money in, and it was held by the government. And whoever came back, they split up that pool of money over time with annual payments. So the word annuity that we all have heard, the word annuity, is annual payments. Now you get annuities that pay you every month, but that process that's out there is one of the most successful opportunities for people to create an income. In other words, there's a stage in my life where you build, like you are. You're grow, and you're going up the mountain. You're saving, you're investing, and you're building it to a giant critical mass, to a jackpot. When you get to the top of the mountain, there's going to be a stage where you're not going to want to work. You probably will. Guys like you and I will always work. You don't have to work, and therefore you tend to work harder.
I couldn't imagine not doing it.
It's just like I couldn't either. Yeah. Steve Wynn's a dear friend of mine. He's 72 years old. He works harder now than any time I've known him. Just crazy. T. Boone Pickens is a friend of mine. He's 86. When he was 68, he retired. He's a billionaire. He's made more money after coming out of retirement in the last 15 years than he did in the first 68 years, and he's having the time of his life, right? But you want to know you don't have to work. So when you get to that peak where you have enough money, now you want to be able to ski down the mountain, enjoy your time with your family, do whatever you want to do, give your time, your energy, your capital, do whatever you want to do. That phase you need income for. And most people aren't planning for income. So you could be in a position where you built your assets up, your stock investments, your bonds, your real estate, and how fast can that drop by 50%, by 30%? We've seen it in every market.
About a nanosecond or
Ray Dalio,
a day? Yeah.
Ray Dalio says point blank, he said, whatever you invest in, most people invest in something they feel is their favorite. They think they know something about it. So he said, you're a real estate guy, you put all your money in real estate. And then you put all your money in stocks, or you put it into commodities, or whatever. He said, whatever investment you invest in, he said, mark my words, in your lifetime, there will be a day that category will go down 50 to 70%. He said, so the only way you protect against that is asset allocation, spreading out against many different baskets, not one. And the other way is you create an insurance policy that says, I'm guaranteed a certain income for life. So what you do is you take a percentage of your earning and you put it in an environment where it grows. And the only problem with that is, I heard annuities, and I was like, annuity to me was the most negative word. It was like,
I know you think about some sleazy insurance sales.
Yeah, exactly right. So you associate to it.
Yeah.
But here's what an annuity is. Bernanke, as the head of the Fed, his top two investments were both annuities. Because I used to read these ads that say, they still market them. It says, what does it say? It says, I hate annuities and you should too. And of course you go to it and it's a guy that's selling you stocks, right? And he says, annuities, they have all these fees, and he's right. There's tons of horrible annuities, just like there's tons of negative mutual funds. There's tons of people who got fees everywhere. They take it every year. And the annuity side, there's a commission paid to a guy. He gets paid once. So I want to be really clear. Annuities aren't a great product. Like mutual funds aren't a great product. The right annuity, the right investment is the right one. And that means you've got to be able to strip out all the crazy fees. You got to know what you're getting. For most people, that's complex. I'll give you a perfect example. A variable annuity, very popular annuity, is filled with fees. It's fees on top of fees. It's fees to be inside of the annuity, and then there's fees for a mutual fund on top of it. It's a disaster. But there are types of annuities, like, done properly, like these hybrid annuities, they call them, where it's tied to an index, meaning a stock market index. So here's how it works. You get the upside without the downside. If the stock market goes up, you get a percentage of that growth.
All right, that was a
if
long
it goes
way.
down,
Again,
you lose nothing. So like you think about my friend who's been out of the stock market for 6 years and he's got nothing to show for it. I said to him, this would have been one of many different vehicles you could have easily done. What's beautiful about these types of annuities, when it's the right company, you want a company that's got the right rating. You want a company, these insurance companies, the good ones have been around 100 years, 200 years. They've been around since recessions, depressions, the 2008, and nothing's hit them. They're that strong. They've been around, that's all they do. And I said, so with these types of them, there's some that are available. Most of them are available only for people in their 50s and above. So it's thought of as something for grandpa. I sat down when I started seeing how these work. There's one annuity I saw, and I'm getting old enough that I'm within the range of doing these things now, which scares me. But one of them gives a guaranteed return of 7% a year. And where are you going to find that?
My immediate reaction.
That's impossible. I know. It's a company that's A-rated. It's been around forever. But here's how they do it. You pay into the company, in this particular one. Your rate grows at 7% a year, and then you have this lump sum. You don't take out the lump sum. That's how you get the 7% per year. What you do is you take out 5% of it a year. And so they show you what that means to you in income. Because what you really want is income. If you're in the stock market and it drops 50%, your income is just cut in half, and then to grow it back can take decades. So there's some that are tied to the stock market. There's some where annuities that are available today, brand new ones, where I saw this one, it blew my mind, where you take the upside of the stock market and they take what's called a spread. So they'll take 1.5% off the top. So if the market goes 10%, you got 8.5%. If it goes 20, you got 18.5%, right? And if it loses money, you lose nothing, and there are no fees if it doesn't make money.
That's a much more attractive proposition.
It's mind-boggling. And then they have a second piece which says, if you leave your money with us and you don't take it out, if you leave it with us, then you can convert that to income in the future. And we can show you how much that would be worth in the future at different stages. So you're able to have something to plan with. So I'm talking about a subject that's really complex. I'm realizing I'm trying to explain this in a few minutes. And I haven't tried to do it verbally. I do it in the book really step by step. But take it this way. If you knew today that you could put a certain amount of money aside, and instead of wondering how the stock market was going to go, you knew that meant for you $5,000 a month, $10,000 a month, $20,000 a month, whatever it is, for as long as you live, and that even if all the money you put in, you'd outstripped, you'd still be receiving the money. That's what you get in these types of income insurance plans. And the way they do it is, some people live very long. Today, people used to, Social Security was developed, 1920s, 1930s, right, under Roosevelt. 65 years old is when you're supposed to get it. Well, the average life expectancy was 62 then.
Yeah.
So it was for the outliers that were being taken care of. And it was to make sure in your older years, 3 or 4 or 5 years of retirement, you'd have some money, you'd be able to live your life, be with your family. Well, today, people living, 85 years. So at 65, they've got 20 years of retirement and they have no plan. And that's the average person, right? If you're married, one of the two people in your marriage, there's an 80% chance they'll live to 92 years old. So we're living longer and longer, and technology is just being started to really be brought to it. And yet we work for 30 or 40 years, and then we're supposed to have enough money for 30 years or 20 years. Most people don't have it. So these types of programs that I explain in here step by step, these programs can give you the income for life so you don't have to ever run out of money.
All right, that was a long one. Again, we talked about indexed annuities is what he hit on here, and the need for income in retirement. He hit on the high fees in variable annuities, which I've talked about in my seminars. Usually don't recommend them for my clients if you're in retirement or getting near retirement. Variable annuities have a lot of fees. You've got the fees for the mutual funds, you've got the M&E expense ratio fees, insurance costs, and then my clients don't want to take on the risk of the market, so they're paying additional money for riders to be in variable annuities to protect their money. So it usually makes no sense at all. You can have 5, 6, 7% fees in these things. The market's got to make 7% just for you to break even. Okay, so we hit on index annuities, which is where you get that growth when the market goes up. Not all of it, but some of it. It locks in every year. So if the market goes down, your returns are locked in, and you never lose any money. So that's what he hit on here. He was talking about that IRS sanctioned umbrella, which is again what you get inside an annuity, just like an IRA. That tax-deferred vehicle that can really power home those returns and maximize everything because you're not paying money to Uncle Sam.
Well, I was with a gentleman by the name of Jack Bogle who started Vanguard. And Vanguard is, the largest mutual fund in the world, but it's an index fund. So they charge very, very small fees, 20 basis points. That means 0.20 when you use basis points, by the way. There's a lot of jargon in this industry. I said to him, I know you believe in investing in the market. I said, but there's a dirty little secret. And the little secret is called sequence of returns. That if you work and you build your whole life up to get this nest egg, and now it's large enough that you can invest in a secure environment and have income coming back to you. It's like your money machine. You don't have to work. But then the market takes a hit. Then it can make a huge difference in where your income is. I said, versus if you have a contract with an insurance company that guarantees you that income, and the company's been around 100 and whatever years, or you diversify amongst multiple insurance companies. I said, those have been proven over hundreds of years to be successful. He said, that's true. I said, the whole dirty secret is, if I'm investing well in the first 3 or 4 years of my retirement, the stock market's up, I might have millions of dollars over the course of my life. If in those first few years it's a 2000 or a 2008 and the market drops 50%, I can show you statistically, you never get back to where you need to be based on your age. So having a balance of assets and having some of these, insurance policies where I know what my income's going to be is the fifth step. It's really making sure that you put the balance in. In a different stage of life, you're going to be focusing on this.
Oh, and that spread that he talked about as something new in the annuity world. It's nothing new. I've been using it for years. It's just a spread, which means it's just one way of crediting money inside your account inside an indexed annuity. There's monthly averaging, there's point-to-point. meaning they just take whatever the S&P was at one point and subtract it a year later, or whatever index you're following. A spread is just another way, and something I use also frequently. What that is if the market goes up 10% and the spread is 2%, that's what the insurance company keeps. You get the difference. So if the market went up 10%, insurance company keeps 2, you keep 8 if the spread is 2. So you can make a lot of money in a spread. It just depends on what the market does, which is why you want to look at all the different ways that they credit money. I love how he calls it the dirty little secret. To my clients, it's no secret. If you've been to my seminar or read my latest book, it's no secret. The secrets of returns is huge, and it's a big risk that you face in retirement when you're pulling money out of your account. You're trying to grow your money safely. It can really affect your returns. It's basically if you're pulling money out and you have some bad years in the beginning of the market, it can really affect your whole income strategy. It can take decades for you to get back. If those same returns were flipped and you got them at the end of the year, well, then you're fine. But so that's why it's important to know this particular risk and work it into all your strategies. So it's no dirty little secret. In fact, it's in my latest book in page 99, The Secrets of Returns and How It Affects You in Retirement. All right, I want to thank you for watching this little video series of mine. If you need to get my book, The Coming Inflation Crisis and the 4-Step Action Plan for Retirees, it hit the Amazon bestseller list on August 16th. I was pretty excited about that. You can go to Amazon.com or BarnesandNoble.com and buy it full price, or you can pay just a small shipping and handling fee if you want to go to my other website called thecominginflationcrisis.com. That's www.thecominginflationcrisis.com. Just pay a small shipping and handling and I'll get that book out to you right away. Thanks so much for watching. I'll see you soon.